Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Uber and Lyft may dominate the ride-hailing industry here in the U.S., but Alphabet's Waymo is hoping for a piece of that pie. And now the company is offering that service with a twist. Phil LeBeau has those details. Phil?
A driverless twist, Kelly. Basically what you're going to be seeing from Waymo starting in the next couple of months in Phoenix is this: self-driving Waymo minivans with nobody in the front seat. Truly nobody in the front seat. You'll have some passengers in the back seat, and initially you'll have some Waymo engineers in the third row in case there are questions, but there will be no safety drivers in the front seat, and it'll start in the Phoenix area, and Waymo believes there are a lot of people who want to go in a self-driving vehicle.
There's no question that there is a large percentage of the public that is absolutely ready and would love to have access to this technology as soon as possible.
So what does this mean for Uber and Lyft? Well, initially, it's unlikely that they're going to lose much business in the Phoenix area. Look, Uber has 70% of the rideshare market in the United States. It has tens of thousands of drivers, and Lyft is growing extremely quickly. It has about 25% of the market. That said, what you're seeing from Waymo is what we're going to be seeing from other tech companies, other automakers, trying to take the rideshare market to the next level in terms of self-driving vehicles. And Waymo believes they have a first mover advantage, and they have nearly 3 million miles of public road testing under their belt, so they can say with confidence, yeah, we think it's not only going to be safe, we think people will want this. It'll be interesting to see how this shakes out as this service rolls out first in Phoenix and then in other markets around the country.
I'll be following it closely. I know everybody will, wondering how this whole experiment goes. Phil, thank you very much. Phil LeBeau. Time for a CNBC News update once again with Sue Herrera. Hi, Sue.
Hello, Chloe. Hello, everyone. Here's what's happening at this hour. French police arresting 9 people, while another was arrested in Switzerland in coordinated counterterrorism sweeps. La Parisienne newspaper said that it was possible that those raids had thwarted a terrorist attack. After casting his ballot in the New Jersey governor's election, outgoing Governor Chris Christie got into a verbal confrontation with a woman. She demanded to know why Mendham Township and Mendham boroughs weren't merged. After an exchange of words, Christie had this sarcastic response.
I'm sure easier to sit here and complain, but you know what? That's the joy of public service. It's serving folks. It's serving folks. Yeah, it's serving folks like you that is really such a unique joy. It really is. You're fabulous. Any other questions?
The latest advice from the American Society of Clinical Oncology is alcohol is a cancer risk. The more you drink, the higher your risk. The American Cancer Society suggests people limit alcohol intake to 1 drink a day for women, 2 for men. That is the news update this hour. Kelly, back downtown to you.
All right, Sue, thank you very much, Sue Herrera. Let's take a look at how we finished on Wall Street, because the Dow had a surprise on the bell. It was a surprise gain of 8 points. That puts it in record territory on that close, 23,557. Not the case with the other averages. The NASDAQ down 18. The S&P a little bit lower. The Russell's down 18. They were the big decliner today, dropping 1.25%. Let's check on some of the earnings names after hours, because we have some more big moves, especially in shares of Snap. They've rebounded. They were down more than 20%. Now still down about 16%. Lending Club also down 16 or 17%. Weak Q4 guidance there. Zillow Group gaining 2.5%. It is bucking the trend. But we'll watch it, of course, as we continue to get more commentary from these companies when their earnings calls get underway. If you missed any of the other big stories today, let's get you up to speed in today's Rapid Recap.
Disney approached Fox, but Fox has been thinking for some time, and this is the key point.
Other questions?
The latest advice from the American Society of Clinical Oncology is alcohol is a cancer risk. The more you drink, the higher your risk. The American Cancer Society suggests people limit alcohol intake to 1 drink a day for women, 2 for men. That is the news update this hour. Kelly, back downtown to you.
All right, Sue, thank you very much, Sue Herrera. Let's take a look at how we finished on Wall Street because the Dow had a surprise on the bell. It was a surprise gain of 8 points. That puts it in record territory on that close, 23,557. Not the case with the other averages. The Nasdaq down 18, the S&P a little bit lower. The Russell's down 18. They were the big decliner today, dropping 1.25%. Let's check on some of the earnings names after hours because we have some more big moves, especially in shares of Snap. They've rebounded. They were down more than 20%. Now still down about 16%. Lending Club also down 16 or 17%. Weak Q4 guidance there. Zillow Group gaining 2.5%. It is bucking the trend. But we'll watch it, of course, as we continue to get more commentary from these companies when their earnings calls get underway. If you missed any of the other big stories today, let's get you up to speed in today's Rapid Recap.
Disney approached Fox, but Fox has been thinking for some time, and this is the key point, I think, guys, that it doesn't have enough scale to compete in this new world.
Last year, all everybody was trying to talk about at Dreamforce is stopping Amazon. This year, I keep hearing Netflix. This is the way to stop Netflix.
ADP shareholders have re-elected all 10 of the company's directors. That is a loss for Bill Ackman, who had sought 3 of those seats.
I think it's the largest margin of victory of any large cap proxy contest ever. And so I think that would hopefully be a message to Bill that it's time to move on.
We're rooting for them. We hope they're successful. If they are successful, the stock price is going up a lot. If they disappoint, we will get in there and we'll be able to make the necessary changes.
I'm sure all of us here on this desk get 1 or 2 PR pitches a week for a new ETF product. Is there a market risk to this?
Well, the question is, do I worry? And the answer is, you're damn right I worry. How could I not worry about it?
That caught my attention there from Jack Bogle, Michael.
Yes, although a consistent message from Jack. And one of the things that he said he's worried about with ETFs is the concentration of the management of ETFs, broad index ETFs with 3 firms, essentially BlackRock, State Street, and Vanguard. Nobody really knows how this plays out as a market risk, as a structural issue for the markets. But yeah, he's, he focuses on the key stuff
By the
that
way,
matters for
they
the
have
long
a fair
term.
amount of assets under management, too.
Oh.
It's just that he says
no, Vanguard, he is in there with those. But of course, he says, the Vanguard, as they often like to say, the Vanguard customer does not trade as heavily and is not as short-term oriented. But yeah, it's a self-selection.
That was fascinating. Time for the takeaway today. We begin with the demise of Black Friday, which is swiftly approaching. PwC says just 35% of shoppers intend to do most of their shopping on Black Friday this year. That's down from 59% just 2 years ago. When are they shopping? Well, on Thanksgiving, for one, with 58% of shoppers doing that versus just 40% last year. And since 2014, Mike, Super Saturday, the one before Christmas, has surpassed Black Friday in sales. What's your take?
I thought Super Saturday was always actually the biggest until relatively recently when they tried to engineer Black Friday to be a bigger thing. I mean, this makes all kinds of sense. I don't think anybody is kind of mourning the loss of Black Friday as a must for those particular deals.
But is it for Thanksgiving? That's the, I was surprised.
I actually think it's just getting all stretched out. I mean, basically, when people are shopping online, they're doing it when they want to do it, as opposed to these kind of artificial moments when the retailers decide to put deals up there. And I do think what it's doing is it's no longer penalizing somebody who wants to get one of these coveted deals for not wanting to go and deal with the scrum on Black Friday.
Another negative for the malls, exactly to your point there. Next, Amazon is launching its own furniture brands called Rivet and Stone and Beam. Restoration Hardware and Wayfair were down on this news today. Michael, how much of a threat is this for the furniture companies?
Wayfair is down quite a bit off its recent highs, like 25% in a couple of months. So clearly that's been the thing that shadowed the Wayfair story for a while, because if you're going to buy furniture online, that you've made that first step. Wayfair is certainly not your only option. I think it's significant. I don't think it's one of those things where it doesn't seem like it's going to be some kind of a major new profit push for Amazon, yet it could kind of obliterate the business models of others.
And that's a perfect example of that. Company gets into business just a little bit, and it's enough for the share price reaction. You can see Wayfair, again, down nearly 6%.
Think of how much Amazon will know about you when you start buying. They know you're either moving or doing a renovation.
Oh, yeah.
I mean, there's a lot
they're buying a crib.
Valuable data.
Yeah, mega. Finally, after reports of haphazard and potentially hazardous factory conditions, Tesla is buying Perbix, a maker of automated manufacturing equipment. The Financial Times, the Journal, had detailed that much of the work to make Teslas has been done underhand, under huge deadline pressure. The cars, Michael, are even arriving unfinished to dealerships where they finish assembling them for delivery.
Yeah, Tesla's obviously stressing the supply chain. They want to try to do more in-house. They're very particular about trying to essentially kind of do more of the vehicle than the typical automakers do. I think it's, jury's out as to whether they can pull this off. Clearly, production glitches. They've missed many targets over the years.
Sounding to me they're getting serious about it.
Any executives leaving? I mean,
yes, and they have to upgrade that. And the shares are up 1%. I wonder if because they say, look, at least they're getting serious about this now.
Yeah, right. So try to get their hands on it as opposed to trying to rely on the outside.
Now we'll see how that goes as they try to get the Model 3 out. Now, millennials, well, we'll talk about them in one moment because we're going to talk about Marriott first. Seema Modi, how did that company do on its earnings?
Hey, Kelly, it is a beat for Marriott, $1.10 adjusted on its bottom line. The street was looking for 99 cents. Revenue also a beat at $5.66 billion. Wall Street analysts were looking for $5.23 billion. Now, worldwide RevPAR, revenue per available room, a key metric we look for in the hotel industry, rose 2.1% in the third quarter for Marriott. And for 2018, which is what really analysts have been looking at, RevPAR expected to increase 1 to 3% worldwide and 3 to 5% outside North America. The stock up just fractionally, but I should point out it has been a key winner in the hotel space, up 70% over the past 1 year. When I spoke to Marriott CEO Arne Sorensen back in October, he really emphasized that the company is focused on its asset-light strategy, so selling off a lot of those core real estate assets from that acquisition of Starwood, which was 1 year back. Back to you, Kelly.
Shares of Snap are down big after disappointing earnings guidance, a 15% drop. Let's get back to Julia Borson with more. Julia?
That's right, Kelly. Those shares plummeting on decelerating revenue and user growth that fell short of expectations. Now, one thing after reading through the prepared remarks, we're particularly curious to hear about on the call, the impact of competition with Facebook and Instagram as they invest more in similar services like those lenses. Not a lot of talk about competition in those prepared remarks, but CEO Evan Spiegel and Chief Strategy Officer Imran Khan both did talk about the shortfall on different counts. They explained they counted an average of users over the quarter rather than that at the end of the quarter, explaining one reason users didn't grow faster. They also talked about the shift to an automated ad sales system having an impact on revenue. But one thing we could hear a lot about in the Q&A session is Snap admitting how difficult the app is to understand and to use. The fact that Evan Spiegel, the CEO, says Snap's redesigning the app to make it easier to use, that could be a good thing. But Spiegel also says in these prepared remarks, quote, "We don't yet know how the behavior of our community will change when they begin our updated application." So there are a lot of question marks for Snap's future, what the changing service will be like, and what kind of impact it could have on growth. Now we see shares down over 16%. Kelly?
I'll be listening keenly for more on the call. Julia, thank you. Shares of Zillow, which also just reported its earnings, are higher after that report. The online real estate company tracks homes, both for sale and for rent. It's up about 3% right now. Today, the Wall Street Journal suggests that millennials are finally looking to buy, which seems to be upending the rental market. Chris Thornburg joins us now. He's founding principal at Beacon Economics, along with Fred Glick, who is CEO at Arriva Real Estate Brokerages and vice president at Honorant, a property management company. Welcome to you both. Chris, from the home ownership stats, it does seem like a big sea change is underway for millennial home ownership.
I'm not sure I'd call this a big sea change. What you saw is the home ownership rate go up by a couple percentage points, a tiny amount really. And what it suggests is this long, languishing kind of housing slump we may be in, we have been, is finally starting to turn up. It's not global, it's not revolution, it's evolution.
Fred, it is bad news for these mega home rental companies that have emerged from the financial crisis, isn't it?
Well, yes and no. There's always going to be people who need to rent for different reasons. Credit, income verification are the ones that will always have a base of people who'll need to rent. And still, there's people out there who like renting. They like to just make the phone call and get stuff done and don't really care or know or in the right economic class to be able to want to buy to get the tax benefits.
Chris, perfectly in agreement with you that basically this is just kind of an incremental move. It's mostly cyclical. And, you know, my rule about stories about millennials is you have to substitute adults between ages of 19 and 36 because that's what millennials are right now. So to say that they're buying homes is no real revolutionary statement. However, there was a storyline that said, you know what, this generation is going to be different. They're going to rent forever. They really like that mobility and that flexibility. So are we seeing evidence that maybe that great long-term bull case for rental properties might be challenged?
Well, I think that storyline was always kind of ridiculous. Look, when the Great Recession hit and, of course, the housing market collapsed, credit became unbelievably tight. In fact, today it's still tight. And that is one of the reasons why the rental market has continued to be strong. Now, in many ways, there is a bit of a shift. The credit's loosening up a bit. As you noted, millennials not only are growing up a little bit, but they're doing much better from an economic perspective because labor markets are tight. And that all suggests absolutely people are going to start buying homes. But remember, a few people buying homes is not going to collapse the rental market. After all, over half the renters that were created after the Great Recession, most of those, about half those folks, ended up in single-family rentals. And of course, those houses will be sold back into the owner-occupied market during the course of this shift, as we've seen in the past. So the multifamily space, while the boom years are clearly behind us, clearly is going to continue to be stable moving forward.
Chris, could we boil this down to a trade? Would you kind of venture in terms of who do you own and who do you not own in this new environment?
I'm an index fund kind of guy, as the case may be. But look, these guys who bought all these single-family rentals are going to do fine because they made their money in terms of the appreciation of the underlying asset. You know, the rental flows were never that big of a deal because trying to manage a portfolio of 2,000 or 3,000 single-family homes is a nightmare. They made their money. Yeah. It's time to get out, and that's going to rebalance the market.
All right, we got to go. Gentlemen, thank you both. Chris Thornberg and Fred Glick talking about the changing housing market. Very much appreciate it.
I had so much.
We have Take Two. I know you do. We'll bring you back. Don't worry. It's personal. I love the story personally. Anyway, Take Two and Match are reporting their earnings. Seema Modi has those results. Seema?
Two stocks on the rise here, starting with Take Two Interactive reporting stronger than expected revenue and earnings growth. Plus, it raised its profit forecast for the all-important holiday quarter season, helped by Grand Theft Auto and its recently launched basketball franchise game. Kelly, I'm sure you're a fan. That stock up over 10%. Of course, this is also a sharp contrast to what we heard from Activision Blizzard. Quick mention of Match Group, shares also rising. Earnings missed the street. Revenue is a beat driven by fantastic performance at Tinder and Match, that according to the chairman and CEO of Match Group, that is Greg Blatt. That stock up 5%. Kelly?
Shares of mall owner GGP up nearly 17% today on talks of a potential takeover by Brookfield. Joining us by phone is Paul Hickey from Bespoke Investment Group, because, Paul, there may be an Amazon angle to this, right?
Oh, yeah. I mean, I think there's certainly an Amazon angle to this. When you look at the, how depressed GGP has been, it all stems back to, death by Amazon, and how Amazon just is going after all these traditional brick and mortar retail companies. Just today, you saw the news with furniture and stocks like Williams, Sonoma, and Wayfair getting hit. But our Death by Amazon index, which tracks the percentage of traditional bricks and mortar retailers that we feel are most impacted by and most under threat from Amazon, it's down 22% so far this year and 40% from its high in early 2015. And when in a market where the S&P is up over 15%, 22% down year to date, that's a big problem. And these mall operators are just the second derivative of that whole death by Amazon trend.
Yeah, Paul, trying to puzzle out exactly how much we should take away from this move by Brookfield in terms of a statement on the overall attractiveness of mall retail. Of course, Brookfield already owns more than a third of this company. So I guess if you already own more than a third of something that's down more than 20% year to date, maybe might as well own the rest of it. So maybe it's not necessarily Brookfield saying, hey, we think it's a bright future for higher end malls, but look, it's a decent asset and we can do better with it privately.
Yeah, no, I think you're exactly right, Mike. It's definitely a special situation in this respect, and this does certainly, taking it private would alleviate some of the public pressure on these stocks. Short interest in the mall operators just in the last 2 years has quintupled from a very low rate of 1.5% of float to over 8% of the average stocks float. So when the stocks keep going down, that doesn't instill confidence in the part of the investment community, and so when the stock isn't trading every day, it's harder for people to become, more down on the group or more down on that specific company.
Paul, we also this week had the big potential news, or the talks, at least between Disney and 21st Century Fox, which also seems to be bulking up against a FANG. In this case, maybe Netflix being the one. Do you think we're going to see more of this, where you have industries that need scale in order to compete effectively against those giants?
I think, that's similar to the media trying to get together. I mean, there's a whole, effort on the part of traditional companies in the retail and media space to solve the competitive threat of what online is doing and the internet's doing. It's essentially taking out the middleman. These are just, you see this in industries that are being disrupted all the time. Does consolidation among industries that are under threat and haven't been doing it right lead to the correct, lead to a positive outcome all the time? Not necessarily, but I mean, at least they're doing something.
Mike, anything that you would say leans against this being a smart deal to do right now?
Well, the price. I mean, obviously, everything at a price. So if you see where it settles out, that would mainly be the thing. No, I don't really think so. Honestly, if you look at some of even the vacancy rates at the better malls, it's trending down, rent softening up, but it's not as if it's a free fall. It's not as if these businesses necessarily kind of fall apart overnight. So, again, if you're already in the business, you might as well be bigger in the business. You diversify your risk, and maybe you can pick and choose which assets to concentrate on within it.
Paul, thanks for... Go ahead, real quickly.
GGP, after these moves in the mall REITs, they're still down 15% in where they were trading back in August. So it's not like they've had much of a move. And if they're willing to sell out at if a company is willing to sell out at this price where it was 2 months ago and still down big year to date, it's not really a big vote of confidence on their part.
Yeah, that's true. Paul, thank you so much for joining us.
Thanks.